Hello, my friends. Today is September 6th, and this is Markets Weekly. So this past week, we saw the S&P 500 briefly touch new all-time highs, but was faded pretty aggressively. I think the standout to me in the market the past week was, of course, gold. Again, continuing to run with its breakout, precipitated in large part due to the non-farms payrolls report, which, of course, was the highlight of the past week and is changing the perceptions of many people, but hopefully none of you, because I've been talking for some time about the weakening US economy and the slowing labor market. So today let's talk about two things. First off, let's talk about the labor market data we got the past week. And secondly, let's talk about the global bond market sell-off that's happening, particularly in the longer dated tenors, say 30 years. All right, starting with the jobs report. So this past week, jobs market data started out with JOLTS. Now, JOLTS is basically showing how many job opening listings are being advertised in the US. And as you can see, it was lower than expected, but not just that, it's basically to a level that's around pre-pandemic. And given that our population is larger today, you could say that it's obviously the job market today is weaker than it was pre-pandemic. So that was, of course, kind of a yellowish red flag. Subsequently, we got the latest ADP report. The ADP, of course, is a large payments processor, so large that it even publishes its own jobs report. And maybe one day, if people have less confidence in the public data provided by the US government, vendors like ADP will become even more prominent. But in any case, their publication was a little bit below expectations. It wasn't terrible, but wasn't particularly special either. Now, finally, we end up at Friday, where we get the big star of the week, the non-farms payroll. Now, recall last week's non-farms payroll was a big surprise because the revisions showed that all those jobs that we saw, a few months ago, well, they were basically illusory. The revisions wiped them all away and showed that the job market was indeed much weaker than expected. So today's jobs market expectations was around 75,000. We got like 20-some thousand, which of course was a big disappointment. But again, like we've talked about, normally we can't just look at the headline number, we also have to look into the details. And when you look into the details, it's also very clearly not good. So wage growth year over year, a little bit lower. So what else? If you look at labor force participation, went up a little bit, so that's good. But then the work week did shrink a little bit, so that's not good. And of course, the unemployment rate ticked up a little bit, but that was also expected. But more alarmingly to me, if you zoom out a bit and take into account the revisions, again, every month there are revisions, you can see that we actually lost jobs in June. We had a negative NFP print. And that's something we really haven't seen in quite a long time. But again, zooming out, looking at the trend, it's really inescapable that the labor market, the jobs being created, is steadily declining. Now, some people would say that this is, because of immigration, less supply, probably, but, it's also very, very clearly less demand. So, I mean, the stories about running it hot or reacceleration, that's just obviously wrong. I mean, it's been completely at odds with the data for months. So I think, even Chair Powell and many people on the FOMC talking about a strong labor market, it's turning out that that was clearly the wrong perspective. Governor Waller was right, the president was right, and it's looking that the Fed actually is too late. So the market took one look at this data and reacted pretty predictably for the most part. So the rates market, of course, saw this and knew that rate cuts are coming in a big way. So looking at the curve, you can see the entire curve shifted lower, with the 10-year really just a little bit above 4% now. So we all knew that we were going to have a September cut, and looking at September, that's basically a lock. Now, there are even some whispers of a 50 basis point cut. That is possible. We probably have to look at the inflation data next week to get a better perspective on that. But the market really isn't pricing in that much of a chance. What the market is increasingly sure of is that we'll get 3 25 basis point cuts this year. I think that sounds totally reasonable. Now, one other thing you can look at this data is if you just look at just where the jobs are being created. So there's a good chart by Parker who has these very good threads breaking out the jobs markets data. You can see that over the past few months, jobs are basically only created in healthcare, basically services for the boomers. For everything else in the economy, not really that much. So for most industries, he has this interesting diffusion index, seems to be losing jobs. So it's very unambiguous now that the labor market is quite weak. And this has big potential ramifications for the economy, because if you don't have a job, then you can't spend money. And if you don't spend money, maybe someone else doesn't have a job. These things tend to escalate in a nonlinear fashion, which is why when you see surges in the unemployment rate, they tend to have momentum. This is what many people describe as the Salm rule or the Dudley rule, and so forth. So this is a part where it's not unreasonable to expect big and aggressive cuts, but at the moment, given where inflation is, and given from the fact that we did have last month what was kind of okay, so I think they won't do that at the moment. But of course, looking at other asset classes, again, more rate cuts, weaker economy, gold surging, U.S. dollar noticeably weaker, again, totally normal. Although for the dollar weakness aspect, we have to keep in mind that things are not going super well in other countries either, but the dollar did leg down notably. Now, what was really interesting to me to begin with was that you saw equities absolutely surge. You have people saying that, bad jobs report, rates lower. Obviously, equities have to go higher as well. I think what happened was the markets opened and some, maybe wiser hands opened up and sold it down. But that was surprising to me. And sometimes good news is bad news, and sometimes bad news is good news. It's always a judgment issue, and in my judgment, thinking that bad jobs report is good for the stock market is going to be totally wrong. And of course, we have to check in with the president to see what he thought about this, and let's listen to him.
Mr. President, tomorrow we have a jobs report coming out, the first since the BLS commissioner who you fired won't be there. A lot of people will be turning to you to see if you believe the data that's released. Can you commit to saying the data will be credible?
The number, I don't know, they come out tomorrow, but the real numbers that I'm talking about are going to be whatever it is, but will be in a year from now when these monstrous, huge, beautiful places, they're palaces of genius. And when they start opening up, you're seeing, I think you'll see job numbers that are going to be absolutely incredible. Right now, it's a lot of construction numbers, but you're going to see job numbers like our country has never seen before. Thank you.
So that's the president the night before, so Thursday evening, at a dinner with tech CEOs. Now, the president has this information at the time. The senior officials in the U.S. government get data like this the night before. And so he's just basically telling you that, maybe it's going to be like this for some time. I think he's bracing for a period of weakness and telling you that after this period passes, we have got all these investment pouring in, takes time to spin up factories. After all, we have Japan, who is giving me $550 billion to invest in the United States. Of course, we're going to create jobs and so forth. So, maybe it'll show up in a year, maybe later. So I think everyone at the BLS can breathe a sigh of relief. He's not going to fire anyone else. And who knows, maybe if we do have new management over there, that we could have different numbers. Also, I should highlight that next week we have something called the QECW or QCW. It's a time when the BLS basically benchmarks their employment data. So what we see on a month-to-month basis is just a survey. They ask a whole bunch of people and then have a statistical model that produces an output that says, yeah, the U.S. economy probably created this many jobs. Now, the benchmark, though, it's going to be thorough. It's going to be much less of a survey. It's going to have tremendous coverage. So it's basically the truth when it comes to the job market. And I think the widespread expectation is that it's also going to show that the U.S. created much fewer jobs than the surveys are indicating. So that's all we have to say about the jobs market. Now, the next thing that I want to talk about is something that's been in the market's focus the past few weeks, and I think it's going to continue to be the market's focus going forward. And that is, we could be at the very beginning of some sort of distress in the sovereign debt market. So just looking at the 30-year bond market, 30-year yields across the developed world have been surging. Now, there was a notable pullback in the US on Friday. After all, if we have a recession, and I don't know if we will, but there is a meaningful chance, then rates will come down, and that will affect the 30-year as well. So even if you have tremendous fiscal deficits, if you have a recession, asset prices come down, consumption comes down, prices come down. There's an economic cycle to this again. But of course, longer run though, if you have a fiscal problem, obviously it's going to have upward pressure on inflation. So looking across, first off, a lot of people were looking at the US 30-year and saying that, it's been around 5%, maybe it'll break through. But if you take a step back, as I've just shown, this is something that is very much a global problem. But I also would like to highlight that there are actually different drivers of this. It's not just all about the fiscal situation, although of course that is an important part. Now, first off, again, we start with first principles. Prices are supply and demand, and people buy and sell for very different reasons. One of the drivers in the huge bond market sell-off is rather technical, and that is you have pretty big pension reforms in the Netherlands. Now, the Netherlands has one of the largest the largest pension system in the Eurozone, about 2 trillion in assets. And they just had a major reform that is going to be ongoing. So pension funds are one of the largest buyers of long-dated bonds because they have long-dated liabilities that they need to hedge. So if you are a pension fund, so you are basically promising to pay someone some amount of money, say 30, 40 years from now when they retire. So one way to hedge that liability is to buy a 30-year asset. So let's say you take money from the worker today, invested in a 30-year bond. 30 years later, as the pension fund person begins to withdraw, you have money to pay them. Your money will continue to accumulate in these long duration assets. So it's an asset liability management exercise. So if you have a change in your pension system, maybe pension funds don't want to buy, for whatever reason, don't need to buy as much longer dated bonds, that's going to have an impact on the prices of longer dated bonds. And that's exactly what's happened in the Netherlands. Now, they, like most pension funds in the past or in Euroland, they have a pretty generous pension fund where you have it's called defined benefits. Basically, boomers get to have generous payouts. However, I'm guessing that they realized, like everyone else, that this is basically unsustainable, right? You made a lot of promises to people. Now that you retire, you don't have enough money to pay out all the promises you have. Looking forward to all the people that are eventually going to need to take out benefits. You could definitely for the boomers, but for the people afterwards, probably not. It's basically a Ponzi scheme structure, right? That's literally how most pension funds work. They are underfunded. They made generous promises. Probably oftentimes a government official made this promise to get elected, and then they basically paid the benefits for the boomers from receipts from younger workers. But again, there's not enough money for the younger workers when they retire. So what they're doing is some kind of restructuring. And the US did something very similar to this in the private sector in the past, that is shifting from defined benefits to defined contributions. So in the US, for example, if you work at a company, you don't get a promised pension. Say you're going to get 1%, 30% or 40% of your salary when you retire. You get to, say, put 6% of your salary into a 401k or something like that is invested at a tax advantaged way. And when you retire, you get to withdraw from that money, the amount of money that you contributed, and the earnings get accumulated over that period. So the Dutch pension system is transitioning to a defined contribution-like setting, whereas especially younger people can put some money in. It will be managed by the pension fund authorities, and what they receive when they retire is what they put in plus the earnings, not some kind of promised benefits. So that means that, well, pension managers don't really have to hedge their longer dated liabilities anymore with say 30, 40-year bonds. They can, probably have to sell some of them. So, or at least reduce their demand for them. So that is shaking up a lot of the European government bond markets, and part of the reason driving the Euro bond markets higher in the longer end. So that is one technical aspect, and it could, of course, reverberate to the United States. Global bond markets are connected. Now, a second major driver of this is, as we've alluded to, the fiscal situation, and that's clearest in the United Kingdom. Now, the United Kingdom is obviously in a lot of trouble. So when the UK budget is, let's say, too high, they're spending too much money, what you would see if the pound depreciate and the UK gilt yields surge. That is classic signs of an emerging market. It's basically a country that has run out of the confidence of the market. So when you run out of confidence of the market assigns you a risk premium in your bond yields. And so that's part of the reason why UK longer dated gilt yields just continue to rise. And you can say that's happening in France as well, as we talked about last week. The French fiscal deficit is large, and looking at the French politics, there really is no path to have meaningful budget reform. And so there's a meaningful risk to the market there. I think it's very unlikely there would be some kind of default, but this is ultimately a political game. It has to do with what the ECB is going to do, what the European community is going to do. France, of course, is a core member, so they do have a lot of political sway then. And of course, ECB President Madame Lagarde was formerly finance minister in the French government, and I'm sure she wants to take care of her own. So we'll see what happens. But again, you also see very clearly in the market a bit of a risk premium in French yields. And I think there's a little bit of this in the United States as well, but it's hard to say. U.S. bond yields have been creeping higher. And the fiscal deficit situation is also not good. And we do have a lot of policy that we saw in April that is making the global investor base a little bit worried. But I don't think it's as obvious to me as it is in France or the UK. And one last reason for the global sell-off in bonds is obvious. It's inflation. So if you look at inflation in the United States, it just doesn't seem like 2% is the target anymore. It really looks like, inflation went up and went down, and now it's stabilized at around 3%. And maybe that's where we'll be for the foreseeable future. I don't know. Now, if you have a large fiscal deficit, again, there's upward pressure on inflation. So I think if you are someone who is holding a 30-year bond, you would have to be worried about that, right? And what if inflation is 3-4% for the next 30 years? That's that makes the 5% 30-year bond yield much less attractive. Now, one thing that I think that inflation is probably playing a bigger role is in Japan. As we all know, in the JGB market, Japanese bond yields are also continuing to rise. Now, again, Japan, also a very difficult fiscal situation and all that. But inflation is more of a problem in Japan than it is in other countries, in part because the Bank of Japan seems to be a bit behind. So one thing that I think really stood out to me was when Governor Uedo over there gave a speech at Jackson Hole, he basically affirmed that he thought that aging demographics is inflationary. This is something that I've been talked about for a few years. I think I've also written about this. But there has been a debate about whether aging demographics is inflationary. There were some people who actually thought that it was deflationary since you would have lower demand. Okay, fair enough. But what that perspective misses, and what very smart people like Professor Goodhart had noticed, is that when you have an aging population, people consume less, but then they also produce nothing. So you have a fundamental imbalance in supply and demand of real goods and services. Again, if you talk about things like savings and stuff like that, that's just another misunderstanding in macroeconomics about what savings is, which is real goods and services, and financing is, which is money. So you have old people with lots of financial resources, but those are just numbers in a database. They're not actually goods and services. You don't actually save buckets of rice as you retire. You have numbers in your bank account that you have to convert into real goods and services that someone else has to provide. So as that imbalance changes, a lot of rich people, boomers retiring, continuing to consume, not producing anymore. Someone else has to do that work, and that's inflationary, especially when it comes to labor. And in Japan, again, they are at the avant-garde of the aging population phenomenon we see in the developed world. You can see that their working age population peaked decades ago, right? They've been shrinking in terms of population for some time. So they've been addressing this as creatively as they could. First off, you have to make old people work longer than they otherwise would have. So you see that labor force participation for those 65 and above has crept higher and is seemingly plateaued at a pretty high level. And they also tried to get more women to work. Japan is a more traditional society, so labor force participation in women has been relatively low, but picking up significantly over the past few decades. But they've totally maxed that out. Old people there's only so many old people who want to participate in the labor market. Same for women. And now they just don't have enough labor. And so you see their wages gradually climb, and that is inflationary, and that just doesn't seem to go away. And if you have this inflationary demographic time bomb, then obviously, 30-year bondholders are going to be uneasy. Now, Governor Uedo also made the I don't know, maybe he's been hanging out at the World Economic Forum or something like that, that, a good solution to this is to have immigration, which of course sounds totally reasonable, but I would also point out that basically all Western countries have been trying this to a big extent. It's been enormously unpopular and has caused and will cause the fall of many governments. And also, of course, in many countries has led to a housing crisis because people don't really build that much. But if you add to your population, everyone needs to live somewhere, so rents go up, and that has hurt the living standards of many people. For example, in Australia, Canada, the UK as well. Okay, so that's all I prepared for today. Next week, let's focus on CPI. Probably not going to be super interesting, but if it is a really cool number for whatever reason, if it's, I think, much cooler than expected, you can easily see the market begin to think about a 50 basis point cut in September. Now, if Chair Powell knew that we had a negative print in June, I'm pretty sure rates today would be lower than they are. So anyway, let's see what happens. All right, talk to you all next week.